All right, so today we're going to take a deep dive into employment and income as it pertains to, of course, purchasing a home, which is going to be a key component of determining someone's ability to repay. Okay, and that's really what this all boils down to is ability to repay. So, in looking at employment and income, the key question is how do you make money? Where does your money come from? And it can come from a couple key categories. So, W two salary, W 2 hourly, employed 1099 contractor, you own your own business, retirement, social security, child support, alimony, and then finally rental properties. So all these are different sources. They all have different ins and outs, and we're going to talk about those here in a deep dive and spend quite a bit of time just to make sure that it all makes sense. So W 2 formerly employed. Um, Here's a quick breakdown of all of the different employment structures that you can be found under W 2. So you have salary. That's going to be pretty straightforward, the most common. A lot of people will assume their salary, but when you're talking about qualifying for a loan, that may not necessarily be the case. The easiest way I could define this is by just saying it's base pay fixed regardless of your hours worked. So, you can take time off, you can call out sick, you can miss work. But at the end of the month, at the end of the pay period, your pay is consistent. It's going to be the same. And that's going to be pretty straightforward. That's just going to be the annual amount divided by 12. If you're looking at the actual pay stubs, depending on the pay period, you just multiply it by how many pay stubs are in the year and then divide it by 12. We're always talking about gross income. So, whatever that comes out on that calculation, that's what you use for qualifying. Now, when you start getting into the hourly pay, things start to get a little bit more gray. So to define hourly pay, this is going to be base pay that can vary based on the actual number of hours worked, which is typically going to be 40. A key indicator on this is, are you clocking in and out? If you're clocking in and out, chances are you're hourly. If you have to take time off, if you're sick, if for whatever reason you just don't want to go into work, well, if you're not there and you don't get paid, that's going to fall into the category of hourly. And when you're calculating this type of income, it's not as straightforward as the salary pay. So in this case, and actually the next two as well, you're going to be looking at a 2-year average compared to the last 12-month average, and then again compared to the year to date. And whatever falls in worst case scenario, that's where you're going to end up using for the qualifying income. So in some cases, you may have a situation where you got a pay raise from one year to the next or mid-year or whatever the case may be. Those items can be taken into account with what we call a verification of employment, where you can essentially take the current pay rate, by the number of hours average worked for these, 12, 24-month and year-to-date periods and recalculate it that way. But the key difference is that you're looking at these 2-year averages, the 12-month average, and again, the year-to-date, whereas opposed to the salary, it's just the current amount divided by 12. Now, in some of these cases where you're salary or hourly, you're also going to have some variable items such as commission or overtime or bonus pays. In that case, most loan programs are going to require you to take, again, a 2-year history, a 1-year history, and compare it against a year to date. With the first bar being you got to at least have a 2-year history of making commission. So if I was in a situation where, let's say I was starting out working at a car dealership, I had, a draw or some type of lower base rate until I learned the ropes, and then I switched to commission, you actually have to have that commission pay documented for at minimum 12 months, but in most cases, you're going to need to have a 2-year history before you can actually use that income as qualifying income. So when you're looking at these variable pieces, it's extremely important that, we're taking a look at the actual history, not that what you're just getting now or what just shows on the pay stubs now. Now, the waters get even a little bit more muddy when you're talking about part-time pay. Okay. Now, from a mortgage perspective, we define part-time as anything less than 40 hours. Okay, if you're working sometimes 40, sometimes 36, sometimes 20, that's going to be part-time pay. And if you're in the category of part-time pay, you have to have a 2-year history of part-time income in order to qualify. And then again, once you've documented that 2-year history, it's the same thing as before. 2-year history compared to the last year compared to your year to date. Now, to kind of catch some people who consider themselves full-time, but from a mortgage perspective, again, they're actually part-time. Some industries have where customarily you may work 36 hours. This is common with like nurses and some fire departments where yes, 36, you're considered a full-time employee from a benefits perspective. But when you're talking about qualifying for a mortgage, these are going to fall under the rules of part-time pay. So those distinctions are extremely important to understand as we're working our way through the qualifying process of purchasing a home. Now, when you're 1099 and self-employed, so 1099 self-employed, for us, we're going to consider that synonymous. But for individuals who are paid like this, they may not necessarily look at it the same way. So we do want to make that distinction. So a 1099 employee or a 1099 contractor, like a W-2 employee, they may work for a company, but that company does not necessarily have them on staff. They're more than likely going to be invoiced. And so what happens is that if you are on a contract where you're making $10,000 a month, when you get your paycheck at the end of the month, it's going to say $10,000. That's a key indication of being a 1099 contractor. Your employer is not taking out taxes for the state and for the government, not taking out Social Security, not taking out any type of benefits. Whatever your contracted pay rate is the pay rate, and that's what we refer to as net. That's what you're getting deposited into your bank account. If you are a 1099 employee, you have to have a 2-year history. Most commonly in the loan process, this becomes an issue when somebody changes jobs. They may go from a traditional W-2 position, again, most commonly like a salary position, into a 1099 contracting position. If that occurs, you have to wait 2 years before you can actually apply for a loan because we have to see 2 years of taxes in order to figure out what the actual income is. Because in that case, your income is not based on the pay slips that are received. They're actually based on the income that you claim. So that's extremely important. So you cannot go from a W-2 position to a 1099 position and qualify for a home right away if you need a mortgage. But you can go from a 1099 to W-2 position in many cases. Okay, so a very important distinction between 1099 and W-2. Now, self-employed is going to be pretty straightforward, pretty self-explanatory. In that case, you basically work for yourself. You start a business, whether it's a painting business, a food truck, you own a mechanic shop, whatever the case may be. You own this business, you are the business, you pay yourself out of the business, or the income that the business generates is your own. Again, you have to have at least a 2-year history. And in both of these cases, we're going to be looking at the income that's actually claimed on the tax returns. So to quickly summarize, the 1099 contractor position, you'll likely receive pay stubs, and you will receive a 1099 at the end of the year that summarizes all of the income. Taxes are not being held within the paychecks. That's an automatic red flag that, hey, this is not a W-2 person. This is a 1099 person. You must claim this income on most commonly going to be Schedule C. And what you claim on the Schedule C is what you will qualify with. So, for example, if you are running a mechanic shop and you say, hey, my gross receipts for the year was $200,000, but I had to buy supplies, materials, parts, I have a small staff that I have to pay out. There's all these different expenses. And so ultimately you don't pay taxes on $200,000. You end up paying taxes on $100,000. Well, that's the qualifying income that you use, the 100,000. And again, in many cases, 2-year average compared to a 1-year average. And then self-employed, you can do self-employed on a Schedule C. We also a lot of times see it on an 1120, which is just a business tax return. But it's important to know if you do file a business tax return, you must have both your personal tax returns as well as those business tax returns. They have to be reviewed in order to determine again that income, even if you pay yourself. Okay. Same thing, 2-year average, 1-year average comparison. And again, same thing with self-employed with your own business. Write-offs. For self-employed individuals, the number one item that becomes a hurdle or a speed bump when trying to qualify is going to be the write-offs. Because, again, you don't want to necessarily have a big tax bill at the end of the year. So it's perfectly legal, and a lot of people do it and take advantage of the fact that they own their own business. And at the end of the year, when they're talking to their accountant or when they're doing their own taxes, you start including all of those different costs that you incur in order to generate that income. So the easiest way to think about this is, again, using my previous example, if you're making 200,000 at whatever business, but you have 100,000 in expenses that was required for you to pay in order to make that 200,000, then your qualifying income is not 200. It's going to be the 100,000. Okay. So those write-offs sometimes can be a little bit of a speed bump. Now, kind of the easiest way to think about it, you can't tell the government, hey, I didn't make a whole ton of money. There's nothing for me to pay in taxes. But then at the same time, turn around and say, hey, look, mortgage company, look at all the money that I've made. It doesn't work like that. You can't have it both ways. So if you're in a situation where, you are self-employed and you have concerns about that, definitely reach out to us and we'll be more than happy to help provide some guidance as to what you could potentially qualify for. Okay. All right, retirement and Social Security income. Okay, very straightforward. Again, retirement, employment history is not necessarily required. You don't need to document it on the application. You just have to be able to show through an awards letter the income that you are actually earning. So, unlike employment, unlike being self-employed, there isn't necessarily a quote-unquote seasoning period when you're talking about retirement income. You can qualify using that income immediately once you start receiving it. All right, Social Security income. So this is very common. It's forgotten when someone's filling out an application. And Social Security income, just like retirement, you qualify with it immediately once you start receiving it. But the part that a lot of people forget is you can also include Social Security income for your dependents. So if you have a child or an adult dependent who is on Social Security, if they are your dependent, so if you're filing taxes and they are a dependent of yours, and the awards letter is made out to you, the applicant, for the benefit of the dependent on the awards letter, then you are allowed to include that as qualifying income on your application. Okay, so that's going to be a common one that sometimes people miss. We're going through the bank statements. We see this reoccurring deposit, and we say, hey, do you receive the Social Security income? Then that's typically something, when necessary, we can add if it helps get somebody into a home that they would like. That would otherwise be outside their means, at least from a qualifying perspective. Okay, child support and alimony. This one also another one that a lot of times is forgotten about. A few extra key stipulations though when we're talking about child support and alimony. You have two different types of support that can be paid. So you have court-ordered support, which if it's court-ordered, you have to supply the court order and it has to be the entire document. Sometimes people get uncomfortable about, handing over, that personal or private documentation. For every single person I know in the industry, we could care less about what's going on in there. I know when I get them, I'm typically just scanning them for numbers just to find out, how much are we actually able to use by court order for qualifying. To use it, you must show at least 3 consecutive months of receipt of the support, whether that is child support or alimony, okay, when it's court ordered. We all know somebody or have friends or have heard stories of, yes, there's a court order in place. I'm supposed to be getting child support, but I don't get it, or it's sporadic, or it doesn't typically come in. When you're applying for a loan, you have to show the last 3 months bank statements where that money has been deposited, or canceled checks where you've actually received payment for the support in order to qualify it. So again, you can use canceled checks or bank statements. This one is sometimes comes up to get a little dicey, but you have to document continuance for at least 3 years. Okay, so if you're getting child support for for your dependent, for your child, and they're 18 years old and it's gonna run out at them being 19 or 20 or 21, you don't necessarily have 3 months of continuance in that situation, and therefore you cannot count it. A lot of court child support orders these days will come and say, okay, well, child support is due until the year 18, until the child's 18, unless they go to college, in which case it will continue until they graduate. In those instances where there's that if-then situation, we cannot assume that the child will ultimately go to college. So if it's going to end by the time they're 18 and they're 16, 17, or 18, then you cannot count that income for a qualifying purpose. Okay. Same thing with the alimony. A lot of times alimony will have a length of time that it will last. And so for that alimony, you have to show that it's going to continue for at least 3 years. Okay. Now, opposite of court ordered, you also have voluntary child support. So if you have voluntary child support, you still can use it even though it's not court ordered, but the required documentation is going to be a little bit different. If it's voluntary, then you have to show at least 12 months of receipt, and it will be averaged over that 12 months, and that will be the qualifying amount, again, so long as it continues for at least 3 years. You can use canceled checks or bank statements, and then you have your 3 years of continuance that is required. Now, in both of these cases, I get questioned periodically if we're using this income to qualify. Well, how do you document the age of the child? If it's not explicitly stated in the documentation, do not be caught off guard if underwriting has to request or requires a copy of the birth certificate, right? Because we have to show the actual age of the child. If they have a government issued ID already, so let's just say, I know it's pretty popular in the state of Virginia where minors can still get at least a state issued ID. That document can be used, but it's important that we have to document something that shows that child's age in order to affirm that support is likely going to continue for the next 3 years. Rental properties and income is another category in our last category of income. So you have 2 main categories of rental properties. You have rental properties that you have obtained, some time ago. They're already in operation. They're already in your tax returns. And then you have newly acquired rental properties. So with existing rental properties, our timeline is going to be, when did you actually get it, and is it in the tax returns? So the tax returns, if they show the rental property already, that's going to be an existing rental property. And that we're going to use the tax returns in order to qualify that income. And same thing, just like with the variable, you'll look at a 12, you'll look at a 24-month average, and then based on that, you'll qualify with the worst case scenario. If you have a newly acquired rental property, or you have a property and you're doing a loan program that allows you to convert a current home, a current primary residence, into a rental property, then in that case, you'll be looking at using the lease that you have in place. And in some cases, along with what we call a rent comparison. And what that is that's just like an appraisal, but done specifically for the purposes of determining market rents for comparable homes. And so you'll use either a combination of that or one or the other. Just kind of depends on the actual loan program. Different programs have different rules when you're talking about that. But in any case, if you're using the lease, you're going to end up looking at the income calculated as the gross rent less 25%. And that 25% is just an industry standard to try to take into account things such as, vacancy. So time when the property is not necessarily rented out, you may be in between leases, any type of repairs or expenses that you have to incur in order to continue to maintain that particular home. So if you have a rent in place, just using easy numbers, let's say it's $1,000 a month is the rental amount. You would qualify that with $750. Important points about income. So can the income be documented? And at the end of the day, regardless of what you're doing or what you're talking about in the loan process, the vast majority of points are going to be, can it be documented, right? So let's say you have a business, you're cutting grass, and you just get paid cash and you don't report the income. If you're not reporting the income, it cannot be used to qualify. Let's say your income is split. Let's say you work hourly and then you get paid a percentage of, whatever business, whatever type of business you're doing. Again, if it's not captured on either a Schedule C or captured on a W-2 and included in the income for qualifying, and included on your tax returns, you cannot use it. Is it consistent? If your employment's not consistent, if the income is not consistent, more than likely you're not going to be able to include it. Examples of that would be, let's say you're a real estate agent, right? And you periodically do transactions or you periodically do business throughout the year. If your income is declining or it's not documented for the current year yet, then you can't necessarily qualify with that source of income because it's not consistent. I've seen instances where people have had situations where they're job hopping. I think the most I've ever seen in 1 year for a non-union worker, union workers are a little bit different. But for a non-union worker, I had somebody have 18 jobs in a 12-month period. That person could not qualify based on the type of program that they were doing because they did not have consistent employment. For example, FHA, they do have a stipulation that limits the number of job changes that aren't warranted based on bettering the employment situation. So this individual was, taking jobs that sometimes pay went up, sometimes pay went down, but for whatever reason, they just could not stay at the same job for an extended period of time. That income does not qualify. If, again, the child support and alimony, if it's all over the place, sometimes you get it, sometimes you don't. Same thing, you're not going to be able to use that. Overtime, if you get it a lot sometimes, but then not so often others, and it drops typically more than 25% when comparing a year to date for the 2 years to the last 12 months to the year to date, then you may not be able to use that portion of your income. Again, there's certain situations like seasonal pay and time where it's customary that you're just more busy, like snow removal or power, electric companies. That might be an extenuating, a special circumstance, I should say. That may be a situation that's a special circumstance. But key thing is again, is it consistent? If you are a seasonal employee or an employee that has seasonal high times, such as, again, electric, snow removal, UPS or FedEx during the holidays where your overtime typically is at the end of the year. If it's not consistently at the end of the year for the last 2 years, then again, that's going to be a portion of the income that you're not allowed to use to qualify. And then the last part, is it likely to continue? Is this a situation where you're seeing the income steadily decline? I have seen people where, they went from, full time, 40 hours plus to, it dropped to 36, and now they're part-time. That's steadily declining. If the income is not likely to continue, then you can't use it. If you can't document in those situations like child support and alimony, where you got to have that proof of continuance that it's not going to continue, you can't count it. And so that's going to be key things that we're looking for. But if your answer to all of these is yes, you can document it, yes, it's consistent, and yes, it's likely to continue, then more than likely you're going to be able to count that income. Okay. So just to kind of recap, again, the key pieces are W-2 to 1099. Can't do that. 1099 to W-2 all day long, as long as you meet the program requirements for those transitions. Do you pay taxes on the income? For self-employed or rental properties, as long as you're paying taxes on the income, then you can, in most cases, count it, as long as it is, again, documented, consistent, and it will continue. All right. So if you have any questions about that, just like always, you're more than welcome to reach out, ask any questions you may have, to get an idea as to how much you could potentially qualify or use for qualifying. We're always here. You can leave messages in the comments. You can direct message me. I am on Facebook and Instagram, and a Google search will pull me up as well. All right. Thank you all for your time, and have a fantastic day.